Sirius XM is a stock that Warren Buffett has heavily invested in. And while it might look like a perfect Warren Buffett stock, low PE, nice dividend, share buybacks, well-established business, I don't really see this as a traditional Warren Buffett investment. This company's assets are not as great as they used to be. Sirius XM basically offers radio services, online, satellite, whatever. They basically are the radio people. They have the biggest market share there. They make money in two ways mostly, subscriber revenue and advertising revenue. And this already reminds me of Spotify a lot. Most of the money comes from the subscribers, a bit from the advertisers, but we look just overall, the subscribers make up most of the money. So then it is important, people need to subscribe. We can kinda ignore the radio advertising business. The question is someone willing to subscribe to Sirius XM for their online radio, their podcast, etc.? And when we look at Sirius alone, they also have Pandora, which is something similar, but we're going to look at that in a bit. They have self-paying and paid promotional ending subscribers. These are basically the guy who got a cheaper subscription because of promotion. We can see they had a huge spike in paid promotions. Obviously, those after some time slowly convert into normal paid people, unless they cancel. But when we look at total subscribers, it had peaked at 34.9 million. And since then, it has gradually declined. And then I'm gonna say, okay, what is the value in this company? If I want to listen on the app only, that cost me $9.99 a month. That is around Spotify prices. Of course, Spotify has raised prices slightly, but there are always cheaper prices for Spotify. Let's just call it $10 a month. And if I want to listen to it in the car, which is honestly a lot of radio is listened in the car. So if I want to listen to radio, if I don't want to only listen to it at work, I'm going to be paying out $25 a month. I do not see value in the $25 a month. Sure, $2 per month for 3 months. You can sign me up for that. But $25, is there the value? And people seemingly think, no, there's not. That is why people are starting to unsubscribe. And that is the reason why the stock is down so much. Now, what about Pandora? They have also started to decline. From 6.6 million down to 6 million. And Pandora was a huge acquisition for them. They paid 3.5 billion for these guys. That is around a third of a market cap. It was paid all in stock. You can see in 2019, despite the massive share buybacks they had, shares actually increased. You still paid $3.5 billion for that. But I think, okay, the company's slowly declining, but eventually they're gonna find a bottom, they're gonna have an audience, and then they still have massive amounts of free cash flow, and they're gonna go back to buying back 8% of shares. No, there's a reason why share buybacks have kinda slowed down. It's their debt. Net debt has exploded over time. From 2014 to 2022, it doubled. And ever since they stopped those massive share buybacks, debt has slowly reduced. They were sometimes buying back 2.5 billion in shares each year, while they were only making 1 to 1.5 billion in free cash flow. So that was a lot of debt for share buybacks. You weren't actually getting that much free cash flow to buy back those shares. Plus they were still paying some dividends, so that was extra debt. So this company was buying back shares at a price of free cash flow of 19, and now that it's at 7, it's not buying back shares. That is the issue with these kind of share buybacks. You leverage up in good times to buy back shares at very expensive prices, and now that prices have crashed, you're not buying back shares anymore. If you think about it, 1.4 billion in share buybacks. If they would have just not leveraged up, 1.4 billion. If they wouldn't have to pay down debt right now, 1.4 billion in free cash flow is around 13% shares outstanding reduced. Without taking on much debt, you would have been able to achieve that right now. But because, of course, every company always leverages up in the good times to then not have the cash in the bad times. So I don't really see this as an obvious Buffett play right here. Buffett loves these types of companies that have a huge moat. He was involved in media before. He bought a lot of newspapers back in the early days, because back then, newspapers had a huge moat. You were the one newspaper in the city, no one could compete with you. You could charge however much you wanted for ads. But when I'm looking at Sirius, sure, it's trading relatively cheap, but also it's declining. It has no moat. And to compete with Spotify, I think they have to massively slash prices because they're just currently bleeding subscribers. And I don't want to make a gamble on where this revenue will end up at. I liked Warner Bros. In a similar situation because it still has some assets that have a huge moat, and it was trading way cheaper. Sure, it's trading at around 8 free cash flow ratio, but the management currently expects this year to make only 1 billion in free cash flow. So that is a 9.2. And I don't want to gamble on where this free cash flow ends up at these valuations. Sure, you get your nice 4% dividend here, and I think that's pretty safe. But you're not gonna have the times of huge share buybacks anytime soon. So let's see, what am I willing to pay for this company right now? Management says they're gonna get 1 billion in free cash flow currently. On the shares, that will be around 2.6. So then we're gonna think about the growth rates. subscribers are slowly shrinking. Now, of course, we're gonna have some buybacks to keep up with that, but I wanna be conservative. I always wanna have some safety in my assumptions. Minus 2% for the next 10 years. Slightly declining business, not fastly deteriorating, just slowly. Slowly losing market share, slowly losing subscribers. What does this company deserve for a terminal multiple? Let's say a 10 multiple. That would be fairly generous even. For such a declining company, it's currently trading at 8, while it's not very clear if it's gonna permanently decline. So I would say a 10 multiple is fairly generous in that case. 35% payout ratio with a reduction due to taxes. That would give us a value of $12.9 per share, 50% below the current price target. Now what if my assumptions are wrong? The company's gonna do okay. Subscribers are not gonna decline. They're gonna do some share buybacks. It's gonna go back to okay. 5% growth over the next 10 years, 12 multiple, well then we would be at around today's value. We would make around 10%. Is this very likely that we're gonna go back to 2% subscriber growth, 3% buybacks, while paying out this nice dividend? That would be around their free cash flow. I wouldn't gamble on it. Maybe this is Buffett's assumption, but it's gonna stabilize, we're gonna be able to do some share buybacks, but even then, I don't see this as such a huge value play. There's not a lot of value here, it would be around a 10% return. Now, what if it goes worse? Company just completely deteriorates, loses even more market share to Spotify, Apple Music, all of this. Fastly deteriorating company, very low multiple, 6 multiple, that's a bit below tobacco, but tobacco is kind of stable, so $8 a share. I just don't see what Buffett sees. But Buffett is smarter than me. Maybe he sees something hidden in this company which I'm not seeing. Maybe he thinks, hey, this is going to be broken up into little pieces and that's going to be worth more. But I just don't see it. For me, the risk vastly outweighs the benefits. The benefits here is not deteriorating business with share buybacks, but it's not trading at these levels where I like it for that, where I get compensated for the risk that the company is in terminal decline. What do you think about Sirius? Write it down below. Have a good day.